Well, there we have it. The rand seeing a percent of weakness filter through so far today. We're sitting at around about 677 right now. What are you making of the kind of risk aversion that's at play and what it's doing in turn to the rand's strength position that we've gotten so used to?
I think that really what's the big story at the moment is that there is unending horror in the Eurozone. I think Friday's numbers out of the US extremely disappointing from the perspective that the non-farm payroll data was something that the market was certainly looking at, keeping an eye on and hoping to see some form of momentum coming through. You need to see the job data picking up. You need to see housing starts picking up. Those are the kind of underlying data, underlying core issues that remain within most of the developed nations and that remain a massive concern, as well as the fact that although we've started to see some form of relaxation around Greece, we've seen the packages approved, now you're seeing contagion in Italy, and it just seems as though the story is ever gaining traction, and unfortunately the two ugly sisters just don't want to go away. And it looks as though it doesn't matter where you look in the developed world, whether it's the UK, the Eurozone or the US, the uncertainty certainly persists. And the funny thing is that we've seen the US almost retain its safe haven status despite the fact that the non-farm payrolls came out so negatively. So it's really just been this war of the two ugly sisters, being the Eurozone and the US, and for now the Eurozone remains the uglier of the two sisters.
Surely then, Brigid, we should be seeing a lot more volatility than we're seeing right now. Instead, the rand is sitting comfortably within what has been a pretty established range.
Look, I think what you're seeing at the moment is, a lot of the market players have been in this movie for a long time. I mean, they've been trading in this kind of environment now for over the last 18 months. And so therefore, we're starting to ask ourselves, what is the actual risk? What does risk look like? Is it the United States, in fact, rather than those more emerging market currencies? And as you've seen in terms of the rand, I mean, relatively stable. It maintains those relative bands. It doesn't move in volatile, trajectories like you're seeing in the euro. I mean, the euro itself moves 2-3 euros on over a trading session, whereas the rand, if we have a volatile session, will maybe trade 10 cents. So, from that perspective, it's been quite interesting in terms of the outcome. I think that what you're seeing right now is more cautious trading rather than complete risk off. So you haven't seen people selling off South African bonds, selling South African rand. You've seen some importers get involved in the local currency around that 670 level as it offered opportunity, keeping the rand within that range of 670 to 680, which is quite prudent in that move that you saw from the euro right up from 144 all the way down to 141. Certainly keeping rand within those relative bands. And like I said before, once again, ask yourself the question, are we really seeing risk off? Not really, but more cautious trading from offshore players in terms of reassessing what their exposure looks like to the likes of the Eurozone and what they deem as riskier assets.
In that reassessment, we've got quite a few highlights on the events calendar in focus, presenting some kind of event risk. And let's start off in the US because we've got the minutes of the last Fed meeting out on Tuesday, and Chairman Ben Bernanke also addressing Congress on Wednesday and Thursday. What specifically would you be looking out for in that regard?
Well, I think there's a couple of issues that are still going to be spoken about. You're looking at the quantitative easing. There will certainly be some ear paid to the fact that we want to know what the US sees in terms of having to continue some form of low level rates for a longer period of time, injecting cash into the system, etc., because that has got contagion effects into the likes of the Eurozone, and the other developed nations. So those are the kind of comments that we're going to be looking for. What's been interesting as well was we saw GDP slow down in China. We saw CPI pick up in China, which puts that Chinese economy under a little bit of pressure, and I think also concerns the likes of the commodity players and obviously those looking to see some form of significant growth out of emerging markets. It does continue to put a little bit of concern around the fact that that growth momentum out of the major engine in China is starting to slow down slightly, with the developed world also remaining relatively sluggish, and that's what you're starting to see coming through on the equity market. So overall, I mean, we are going to see data out this week. We've got manufacturing in South Africa. We've got retail sales out of the United States. But ultimately, the numbers that you really want to be looking for are numbers like inflation, numbers like housing, numbers like jobs data. These are the core issues that we really need to start seeing some form of turnaround in.
When it comes to the Eurozone, of course, we've got contagion fears dominating things at this stage of the game, with meeting of European leaders underway. While that plays out, in the background, we're also anticipating the results of bank stress tests, and that expected to hit the market on Friday. What are your expectations in that regard?
Look, I think, for now, the stress tests that have already been run, yes, they've only been in the top 5 banks, have come out positively. They are sufficiently capitalized. I think the big concern really is, what happens if there is a default? What happens and where do they accumulate that kind of cash from? The other thing is also repayments of loans. Those are going to start coming through towards the end of this year. And has Italy, in fact, got the facility to be able to repay the loans on their debt? Specifically now, as you're starting to see CDS spreads blow out because of the concerns around that underlying debt. And that's unfortunately what you start to see. I mean, you saw it in Greece where the bonds themselves and also the underlying interest rates starts to elevate because the market pushes it that way, ultimately because they're concerned for the underlying sovereign. And those kind of contagion effects, what ends up happening is that they can't repay the debt at those current levels. So it becomes a bit of a snowball effect. And I think that that's what the big powers that be in the IMF and certainly in the Eurozone, being Mr. Trichet and his crowd and the ECB, are very concerned about containing that kind of trade, the CDS spread blowouts, the blowouts in the yields in the underlying sovereigns of the various states that do remain relatively vulnerable within the Eurozone.
Brigid, before we let you go, run us through the kind of activity we're seeing in our local bond market specifically, because on the surface it looks like they're being sold, but sold off pretty slightly.
We're not seeing a lot of aggressive trade. We've actually seen relatively thin trade today. Mondays generally are a lot of guys reassessing what their positions look like. Also a lot of uncertainty around what's happening in Europe, and the move that we saw on the US Treasuries on Friday was quite significant. We didn't see a significant sell-off in South African bonds, and in fact, if anything, I think that they still offer yield to the offshore player. We're still seeing, they're still carrying a good couple of percent in terms of what they're having to pay for their funding either in the US or in the UK. And from that perspective, the rands remained relatively range bound, which offers a relatively good investment opportunity for certainly for the remainder of the year, until we start seeing some form of change in the interest rate outlooks of the developed nations. So I think for now, bonds are likely to remain relatively strong within that sort of 730, 760 band for now, as foreigners still remain net buyers of our bond markets.